Hello friends, we often take loans and we are charged interest on the loan. The rate at which this interest is charged may be of two types. One may be called as fixed interest rate, while the other can be called as floating or fluctuating interest rate. What are these two? Let us try to understand in brief in this episode. When you go for a loan, the banks or the financial institution will charge you some interest rate. Till globalization or the new economic policy in India, where there was no much liquidity with the banks. But after globalization, the banks are flooded with money, and we know that they have ample loanable funds. So they have got the freedom also after globalization to charge the interest on the loan. Banks have the freedom, banks have money, and naturally banks would like to give more and more loans to earn more and more profit. They have worked out some different ways, methods for increasing their loans. One such method is the charging of either fixed interest rate or floating interest rates. Banks and financial institutions give this freedom or choice to the borrower, and the borrower can select either of the two, fixed or floating interest rate. In other words, they can take the loan with fixed interest rate or they can take the loan with floating interest rate. As the name indicates, fixed interest rate is that rate which remains constant, which remains fixed throughout the tenure of the loan. For example, if I take a vehicle loan or home loan, and the repayment period of this home loan is, let us assume 5 years or 10 years. And if I select fixed interest rate for my loan, in that case, the rate of interest which is charged by the bank, say for example it is 9%, that will remain constant for all the years of my repayment period. So if the repayment period is 10 years, I will have to pay the interest at 9% for all 10 years. That is fixed interest rate. Of course, this fixed rate of interest need not be the same for all 10 years. At the time of taking or giving the loans, there can be an agreement that this interest rate of 9% will remain constant, say for example for 3 years, and it will change after 3 years. That will remain constant, say another for 3 years, and so on. But the rate of interest is known in advance, and that rate of interest will remain constant for a given period of time. That is called as fixed interest rate. Of course, this interest rate gives the facility, certainty to the borrower to work out the amount of interest. And that amount of interest he can know in advance, and he can calculate the total cost of the loan for the tenure of the loan. This is the benefit of fixed interest rate. However, there could be floating interest rates too. As the name indicates, this interest rate fluctuates. It doesn't remain constant throughout the period of the loan. The bank and the borrower may agree to have this rate changing. How this rate is changed? It is linked with some basic interest rate, or that can be called as, for example, some index. Just to give you an example, LIBOR is the internationally accepted rate of interest. London Interbank Transaction Rate, that is LIBOR. So when banks borrow in international market, they borrow it at this rate. This rate can be taken as the basis for charging the interest on my loan. So my interest rate for home loan will be dependent on the LIBOR, and there may be some spread. Suppose the LIBOR is 3%, then my interest rate, for example, if the bank charges me 9%, if LIBOR increases, my interest rate will also go up. If LIBOR falls, my interest rate will also fall. But this increase or fall will be within what range? It is specified by spread. For example, it could be 0.5% of LIBOR. So if LIBOR goes up, my interest rate can go up to that level of 0.5%. This is called as fluctuating interest rate. Of course, LIBOR will change every day. My interest rate will not change every day. As per the agreement, it will be decided in advance that this change in the interest rate will be, say, after 3 years, every quarter, every 6 months, like that. So changing interest rate, which is dependent on some other interest rate or index, is called as floating or fluctuating interest rate. Now, which interest rate the borrower should accept, which is beneficial to him? Of course, for easy calculations to the borrower and lender, fixed interest rate is very, very useful. But so far as cost is concerned, many times the fluctuating interest rate normally is somewhat more than the fixed rate, because fixed rate has some certainty, floating rate has no certainty, and hence that rate is normally more than the fixed rate. Of course, those borrowers who have some study, some knowledge of the trend in market interest rates, they can study that trend, they can add to that their expectations of the future interest rate changes. They can also consider the period of loan. If the period is longer, the risk increases. If the period is short, the risk is less of changing the interest rate. And also the capacity of the borrower to bear the risk is also one of the factors to be taken into consideration while selecting fixed or floating rate. Of course, a common borrower having no knowledge of this analysis, having no knowledge of how to find out the future expected interest rate, for them it is better, because the risk taking may be less, for them it is better naturally to have fixed interest rate. Of course, this freedom is with the borrower. I think the borrower, on the basis of his own understanding, his own capacity, the period for which he is taking the loan, the amount of the loan, all these things he will take into consideration and then will decide which type of rate of interest he should accept for the loans. Today, I think this is something about floating and fixed interest rates. Let us meet next time with some other concept. Till then, goodbye.